Source code speaking. NFP just hit the tape, silver got shoved down toward $82. It even tagged the high 81s intraday, and a lot of people are already acting like the whole move is broken. That is the setup. That is what happened. But the part that matters is not the paper dip you saw on the screen. The part that matters is that Shanghai is still holding a double-digit premium over Western pricing, even after the volatility, even after the dollar reacted, even after the market tried to shake out weak hands again. That disconnect is still alive, and tonight, that is the real story. If you only look at the headline move, you will miss what the market is quietly telling you underneath the noise. Silver pulled back, yes. The dollar reacted, yes. But the physical side did not suddenly cool off just because a jobs number landed. The stress inside the system did not disappear. The premium did not vanish. The inventory trend did not reverse. The structure is still there, and that is exactly why this moment matters more than most people realize. Let's keep this clean and direct. The jobs number came in soft enough to keep the slowdown narrative alive, but not soft enough to create immediate clarity. That is why the reaction felt messy. You got a dollar bid on impact. You got pressure on silver. You got traders chasing the first move like it was the full story. And within that confusion, price dropped into the area that had everyone emotional again. This is what these markets do best. They weaponize uncertainty. They punish people who need instant confirmation. Silver came off the bounce zone, slid back toward $82, wicked lower intraday, and then started chopping instead of cleanly reclaiming momentum. That is not a strong short-term picture. On the lower time frames, it is still weak. It is still noisy. It is still a market that can punish anyone trying to force a trade just because they feel like they need action. If you are looking at this environment and thinking the answer is more leverage, the market is probably already setting the trap for you. The key level everyone should be watching is not some fantasy moon target. It is whether price can actually reclaim strength with conviction. Not a fast spike, not a headline wick, not one emotional candle that gets screenshotted and celebrated. A real move. A real body close that tells you sellers are losing control. Until that happens, the honest read is still caution. Patience is not weakness here. Patience is the edge. And this is where the gap between paper and physical becomes impossible to ignore. While Western silver got pushed down, Shanghai futures were still sitting dramatically higher on an equivalent basis. Spot in Shanghai stayed elevated too. That premium, still holding above $13, did not get erased by this reaction. Think about what that means. Western paper says silver should be cheaper. Shanghai cash says real metal is worth much more. That is not a tiny pricing quirk. That is a message. It is the same message that has been building for weeks. Real demand is not expressing itself where most people are looking. Real price tension is not being discovered where the headlines point you. The mainstream screen shows you New York paper. The deeper signal is showing up where cash for physical metal is still bidding aggressively, even when fear comes back into the tape. That is why this matters. This is not just about silver dipping after NFP. It is about silver dipping while the physical premium refuses to collapse. Now step back and add the inventory story on top of that. Physical silver continues leaving the system, not in one isolated location, not in one single report, across multiple channels. Shanghai inventories continue to grind lower. February withdrawal data came in hot. Combined withdrawal figures across the first 2 months of the year came in at a pace that should make anyone serious stop and pay attention. That is not what cooling demand looks like. That is what persistent drawdown looks like. Now add the Western vaults. More metal continues to leave there too. Different custodians, different names, same direction. Registered silver stays tight. Total inventory stays near depressed levels. Open interest has been washed down hard compared to historical norms, which tells you something else important. The paper crowd is less dominant than it used to be. When fewer gamblers are crowding the casino still tries to set the narrative, but its grip weakens. That does not mean manipulation disappears overnight. It means the disconnect between paper pricing and physical conditions becomes harder to hide. And that is the part too many people keep missing. NFP did not reverse the physical drain. NFP did not fix inventory tightness. NFP did not kill the Shanghai premium. NFP did not suddenly flood the market with easy silver. It only created a headline reaction in a market already on edge. If your whole thesis changes because of that, then you never had a thesis. You had a mood. There is another layer here that deserves attention, and that is the volatility complex sitting around silver. Large positioning in SLV continues to matter, not because it proves some simple one-way bet, but because it tells you sophisticated players are built to extract value from violent swings. Massive underlying exposure paired with an even larger option structure means one thing very clearly. Big money does not need your direction to be right. It needs movement. It needs panic. It needs acceleration both ways. That is why this tape can feel so hostile, because it is built to punish emotional certainty. And when volatility traders are positioned to feed off expansion, you get exactly what we keep seeing. Fast upside that drags in late buyers. Sudden downside that terrifies them back out. Confusion, churn, exhaustion. That is not an accident. It is the environment. So when people ask why silver can look structurally strong and still trade like this, that is part of the answer. A powerful long-term signal can exist inside a brutal short-term battlefield. Now widen the lens even more, because this story is not happening in a vacuum. NFP landed into an already unstable macro backdrop. War risk is still active. Energy routes remain sensitive. Insurance costs around critical shipping areas remain elevated. Oil risk is not gone. LNG disruption risk is not gone. Regional escalation risk is not gone. Every one of those variables matters because they all pressure the same system from different angles. They all increase stress. They all make physical flows more political, more fragile, and more expensive. That matters for precious metals because in a fractured world, metal does not always move according to textbook finance logic. It moves according to strategic need, political alignment, supply access, and urgency. Gold flows that once looked purely financial start looking geopolitical. Silver begins to behave less like a sleepy industrial input and more like something nations and institutions do not want to be short of when supply chains get ugly. That is the deeper backdrop behind all this. The market is not just pricing a jobs report. It is trying badly to price stress on multiple fronts at the same time. This is why psychology becomes everything. People love straight-line stories because they are emotionally easier to live with. If silver is bullish, they want it up every day. If it pulls back, they feel betrayed. If it bounces, they feel validated. Then when it dips again, they feel confused. That emotional cycle is exactly what destroys people, not the data, not the chart. Their inability to separate signal from discomfort. A thesis is not the same thing as a trade. That needs to be said clearly. Believing silver is structurally strong does not tell you where to enter, where you are wrong, how much size is appropriate, how long you are willing to sit, or what conditions would change your mind. Without those pieces, you do not have a plan. You have a sentence. And this market eats people who confuse conviction with preparation. Right now, the short-term read is still mixed. The dollar did react. It did test an important zone again. If it reclaims strength and starts closing decisively above those recent highs, pressure can absolutely continue in paper metals for a while. That risk is real. It is not bearish propaganda. It is part of the setup. But if that dollar move fades again, if it fails to hold its breakout attempt, then the pressure that hits silver on the headline can unwind fast. That is why patience matters. You do not need to predict every 5-minute move to understand the battlefield. And yes, there is still a real bearish case in the near term. Growth fear can remain messy. Liquidity events can hit everything. Dollar bids can reappear on every new scare. Talk of potential official sector metal sales, even if it never fully materializes, can still spook the market temporarily. Low open interest can mean washed out weakness, but it can also mean thinner participation. These are real factors. Ignoring them because they are inconvenient would be unserious. But none of those risks erase the structural signals sitting right in front of you. Physical silver continues to leave exchanges. Shanghai continues to pay up. That premium widened on weakness instead of collapsing. Vault metal continues to drain. Those are not narrative tricks. Those are conditions. And conditions matter more than emotions. The most important question now is not whether silver had a red reaction after NFP. It did. Everyone can see that. The important question is what happens if paper weakness persists while physical demand stays firm or accelerates. Because that is where this disconnect stops being something only careful people notice and starts becoming impossible for the broader market to ignore. If the paper price keeps flashing stress while the real-world premium refuses to break, the gap eventually becomes the story. And that is when price discovery gets dangerous. Because markets can lie for a while, but they cannot lie forever when real metal keeps leaving the room. At some point, the cost of pretending becomes too high. At some point, the spread between where paper trades and where physical clears becomes too obvious. At some point, participants who only trusted the screen start realizing the screen was only part of the market. That is the pressure building underneath all this. This is also why discipline matters so much right here. There are always people on both sides getting wiped out. The euphoric buyers who chase green candles because they cannot stand missing out. The panicked sellers who dump red candles because they cannot stand discomfort. Both are reacting to noise. Both are feeding the machine. Meanwhile, the people who actually define their risk, track the variables, and refuse to let one headline control their whole worldview are the ones still standing when the move matures. That is the difference between wanting to be right and wanting to survive. If your goal is to understand this market, then your job is simple. Track the jobs data, yes. Watch the dollar, yes. But do not stop there. Watch the physical side. Watch the vault reports. Watch the withdrawal trends. Watch the premiums. Watch whether inventory keeps bleeding out even when paper takes a hit. Those are the things that tell you whether the structural case is weakening or strengthening. Those are the things that matter after the noise fades. And right now the verdict is straightforward. NFP landed, silver dipped, the market got loud. But the long-term structural picture did not break. The physical drain did not stop. Shanghai did not blink. The premium is still there, still elevated, still sending the same message it has been sending. Real metal is being valued differently than Western paper wants you to believe. That does not mean tomorrow has to be green. It does not mean the next candle cannot be ugly. It does not mean volatility is over. It means the core signal is still intact. And when the core signal is intact, every emotionally driven overreaction becomes something you study, not something you worship. This is financial warfare for attention, for capital, and for conviction. The market gets loud on purpose. It wants people tired. It wants people impulsive. It wants people so obsessed with immediate price that they forget to ask the bigger question. Where is the metal actually moving? Who is paying up for it? What changed beneath the headline? Those are the questions that matter. So here is where we stand. The NFP test hit. Silver got shoved lower. The short-term tape is still not clean. The dollar remains a variable you cannot ignore. But the physical market is still telling the same story. Silver continues leaving the system. Shanghai continues paying a massive premium. The disconnect is still open. The drain is still active. The pressure is still building. And that means the real move may not be the one you saw on the screen today. It may be the one that is still coming. So do the work. Pull the labor data yourself. Watch the dollar close yourself. Check the vault reports yourself. Track the withdrawal numbers yourself. Follow the premium yourself. Because the people who verify the system do not need to be spoon-fed a narrative after the move is over. They already know what happened. They already know what mattered. They already know which part was noise and which part was signal. Stay logical. Stay disciplined. Protect capital before ego. Manage emotion before position size. Because in markets like this, the people who survive the confusion are the same people who are ready when the disconnect finally snaps into the open. And if that premium keeps holding while the metal keeps draining, this story is not getting weaker. It is getting harder to contain.